So today we are talking about CRT. Like I just said,
Yes.
this is already like last main thing, and which is going to be uh, a very interesting lesson, especially for you since you prefer trading
Yes.
the CRT strategy. Now, CRT stands for candle range theory. Okay, CRT stands for, let me just put that down. We have CRT. It stands for candle range
Yes.
theory. Now, this simply means that a candle becomes a range. All right, we use
Yes.
candle as a range, and this definitely means that we are talking about higher time frames, not necessarily like lower time frames cannot do the same thing. They can do the same thing, but you know that the range of a higher time frame is quite bigger. So we prefer using ranges of higher time frames. Though you can still use a range of a lower time frame and stuff like that, but the range is quite small. Now, just like you see here, this is a daily time frame. This is a daily time frame of Euro USD, and you can see here, this was a CRT. Price took the high of this. Now, look at this range. Price took about how many days? 1, 2, 3, 4, 5, 6, 7 today. After this, after taking the high of this candle, it took about 7 days to just trade down to take the low. Now,
Yes.
if this was the 5 minute, this would not have taken long. So, but since the daily, it has given us that time. It has given us that time to trade, which it has given us a wide range of pips to actually catch. That's why when we're talking about ranges, automatically you should be thinking of higher time frames. Now, what actually uh, what actually is this candle range? Why should we use ranges? Okay, why should we use ranges? Now, if you remember the lesson that we had on ranges, which is talking about premium and discount. Now, basically, you know that this is how the market moves. All right, it creates lows and stuff like that. It creates lows, highs, and so this is like a line chart. This is like a line chart. And then what you're definitely going to see practically in the market is that the market does something like this.
Mhm.
It moves, creates lows, rates the lows, and then it goes back to rates the highs and stuff like that. This is practically how it happens almost all the time. Why? I told you that because when the market is moving, all right, when the market wants to buy, it needs sellers. So it needs to trade to where sellers are sitting, which the sellers are actually people that are buying in early. So when people
Yes.
are buying in early, they put their stop losses are now sell orders. So the market has to trigger them so that you will have liquidity to buy. That's basically it. Now, if we're looking at this to be like a line chart, then talking about using putting it into a candle
Mhm.
form, it will possibly be something like this. Take note. It can possibly be that this was a daily candle.
Yes.
This was a single daily candle, but now this is the 1 hour time frame. So we have so many 1 hour candles here, but on the daily time frame, it was a single daily candle that traded up like this.
Yes.
It since on the 1 hour we have so many candles, but now you notice that the 1 hour is the time frame that gave us a range. I'm not talking about a candle now. The 1 hour
Mm.
gave us a range, and then the daily time frame is giving us a single candle. Now, price took out the range on the 1 hour, and now you will notice that on the daily time frame, another candle opened and then took out the high of this previous one and then started to trade down. Okay. Now, when it
Yes.
trades down, probably another opened and probably it trades down to take the low of this original range before maybe price starts to move higher. Now, this daily time frames is showing us candles, but when we go down to the lower time frame, we are seeing ranges. Okay, we see
Yes.
ranges on the lower time frame. Now, let's quickly look at an example here. Like for example, I said this is the daily time frame. Okay, this is the
Yes.
time frame here. So
Yes.
which means that if I go to the daily, right? If I should mark out this is the high. Okay, This is the high of the candle here. That was the high of this long bullish candle, and then the low of the candle comes in here. This is the low of the candle here. So you will notice that this is a whole range on the lower time frame. This is a range on the lower time frame where we have, this is the low, and then we have the high right here. So basically, 4 hour is telling us that this is a range high and this is a range low. And what do we have on the higher time frame? It's a single candle. It's just a single candle. Then price took the candles high the next day and then comes back to take the candles low the second on the 7th day. Now, what am I trying to explain here? What I'm saying is, when we're talking about candle range theory, it simply means that we are looking at the higher time frame to point out a candle and use its range. When we are dropping down to the lower time frames, we will now have a range. We will now have a range, like a range low and a range high. Why? Because on the higher time frame, since it's just a single candle, on the lower time frame, we're going to have multiple candles, and then this is what it's going to look like on the lower time frame. Okay, and
Yes.
now, just like I mentioned, if price is going down, you know that it's going to create a highlight that come back, take this one, and then continue down. Do the same thing like that, and then continue down. Now, this high, this particular leg is going to be a higher time frame candle. This leg is still going to be a higher time frame candle, and when price comes back and read the high, it is breaking. It is reading a high on the 1 hour time frame, but just reading a high of a candle on the higher time frame, just taking the previous daily candle's high. Now, let's talk about candle range theory, the concept. Now, the concept states that you have candle tree. We have ranges starts from 2 candles, because you can have candle 1, but candle 1 is always your range. Okay, I'm going to teach you how to point out the ranges, but you always need to have candle 1, which is going to be a range candle. Okay, which is maybe now going to be like something like this on the 1 hour, like that. And then when candle 2 opens, what you want to see is a rate of the high of the candle range, which is candle 1, and a tap into a key level. This is the most important thing. Okay, a tap into a key level. A tap into a key level. When candle 2 taps into a key level and then closes back within the range of this candle, take note of this second thing.
Yes.
Okay, it closes within the range of the first candle. Take note, it rates the high of your candle 1 into a key level, comes back and closes within the range of that candle 1. Now, this validates a CRT. This validates a CRT only with 2 things: tapping into a key level and closing back within. Now, when I say key level, I mean that this key level is supposed to resist price to keep going down. So when price trades into, let's say now this was a bearish order block, price trades into it, rejects, close back within, then we expect candle 3 to start targeting the low of our candle 1, which is our CRT candle. It was our candle range. Okay, now I've mentioned 2 important things: price tapping into a key level in the direction of the order flow, and then closing back within. Now, sometimes you can have price will tap into that ladder, and then just that same candle, price trades down and rates the low. It's very possible. Sometimes you will have the next candle 3 to do the job. Sometimes it will be candle 4 to do the job. Sometimes it will be 7 candles, just like the scenario that we saw here. Okay, so it's very important. The most important thing is for you to wait. You mark out your candle 1. This your candle 1 is just like a range. All right. Now, when the high is rated or either the low, you're asking yourself this third question: is it rating to a key level or not? If it rates to a key level, good. If it rates to a key level, good. Now, how is the close? Because when it closes above, there are high chances that the new candle that closes above might even become the new CRT, which means the next candle now can now open and then take the high of this one and then treat this one now as a CRT instead of this one. So when price closes above it, invalidates this one to be a CRT. it invalidates it to be a CRT. It's just like we've had a clear break of structure to the upside, okay, on the 1 hour time frame when prices close above that previous candle's high. Now, when that happens, when it closes below, we expect lower prices. If it closes above, we expect maybe price to push higher again. Maybe now we can use this as a candle range. Now, the confirmation here is that price should close below or within the range of your CRT candle. If it closes above, it invalidates. Now, you're going to notice that sometimes price can rate the CRT high like 2 times. It happens. But if it rates 2 times and still closes back within the range, the CRT candle is still valid. It's still valid. Okay. And now, talking about, this is just basically everything that has to do with CRT. Already, you know how to point out where price is going, which is actually one of the most important things. Now, for price to move in that direction, it's going to create CRT candles as we're going to see some examples. And then you follow the validation process I've just mentioned into a key level, either fair value gap or other block or a breaker, and then closes back within the range or the CRT candle that you've pointed. Also, a good body candle is always recommended. You prefer choose big body candles because they're going to have a wider range, which leaves you with a good risk to reward ratio as well. Now, if all of this is done, then what you now need to do now is to choose your entry model. Your entry model can be after price rates, when price rates the CRT high, when price rates the CRT high, like that. Now, at this point, this is advanced entry. And advanced entry here is that you step down to the lower time frame, and if price closes below any last bullish up close candle here, that candle becomes your order block, and if tested, you get your entry from there. Now, that's an advanced entry, but for a more safe entry, you wait for this candle to close first. If it closes now, you look for your entry on candle 3. Your entry now on candle 3 can be on a fair value gap or on a breaker, or still on the other block if the other block was not mitigated. That's for a safer entry or for a safe CRT. All right, because catching this move here needs some, you need to be very smart about it. And if you're not yet advanced to that level, you wait for candle 3. That means you wait for candle 2 to close back within the range and validate that CRT before you try to enter. Because sometimes you can enter from here, trying to catch the top, and this candle ends up closing above this previous daily high, then you know already that the CRT is invalidated, right? So it's always better, it's good to wait for candle 2 to close, and then you start looking for your entry on candle 3, either on FVG or not, okay? Now, also, I just want to give you all the information before we go to looking at examples. Now, if you spot your time alignment on CRT is very important. It's very, very important. Now, when you spot your CRT on the weekly time frame, your model 1 entry comes from the 4 hours, okay? Comes from the 4 hour time frame, which means that if you see a CRT candle, to look for your entry confirmation based on model 1 other block formation, you go to the 4 hours. Now, if you see it on the daily, you use the 1 hour to get your model 1 confirmation. If you see it on the 4 hour, you use 15 minutes to get your model 1 confirmation. If you see it on the 1 hour, you use the 5 minutes to get your confirmation. All right, then 30 minutes, you can be going down to 3 minutes and 1 minute time frame. But I mostly recommend these higher time frames as from 4 hour upward to spot your CRTs and get your model 1 entries, because I don't like going down to too much of a lower time frames, like 5 minute download. Now, this is important for your time alignment. Someone that is a swing trader can spot an entry on the weekly, or can spot a weekly CRT and uses the 4 hour as an entry confirmation. Somebody trading the daily will use 1 hour as their entry model 1. As a daily trader, you use 4 hours as a range. You can trade the 15-minute model 1 entry. All right, this is time alignment based on trading your CRTs. Now, let's quickly see if we're going to have some nice examples. Let's use the daily chart. And like I said, when you're using the daily, you want to use the 1 hour as your entry model. All right, you want to use the 1 hour as your entry model. Now, let's just start from here. Looking at the daily time frame, there was price actually traded up into a 3 months key level here, which is at this point. So this is a key level. Or let's confirm that together. All right, an order block. Okay, so price on the 3 months time frame. Take note. On the monthly time frame, sorry, traded into an order block. So we have a key level. Now, going to the daily time frame, look at what we have here. We on the daily time frame, price rejected, did not form as a CRT. Okay, but then traded down, creating this order block for us. Okay, but now looking within this order block, we see that we have a mitigation here, which is this candle. So this is an order block for us. This is an order block for us. Now, at this point, we see a huge body close candle to the upside, and we have a mitigation block. So definitely, we can use this candle as our CRT candle. Okay, we wait for price to read the high, and then we target the low of it. Now, what are the elements that I mentioned to validate? Trading into a key level, which is this order block, and also closing back within. You can see that Tuesday, price took out the Monday's high and then closed back within. So this is a validation that we're looking for price to go down to take out the low, okay, to tackle the low. Now, since this is a daily CRT that we've spotted, which time frame do we use to get our model 1 entry?
This is the data. It's 1 hour. The
Right.
1 hour. The 1 hour. You're using the data. You use the 1 hour to get the model 1 entry.
So we go to the 1 hour to get our model 1 entry. Now, take note of this. I mentioned that the moment price rates the high, okay. Now the last up close candle, you use it as your model. When price closes below it, it becomes your model 1. So this is the last bullish candle that operated the CRT high. So the moment price traded below that candle, that becomes your other block, right? That becomes your other block. Now in this case, there are high chances that price should not be taking out this high again. All right. There are high chances that price should not be taking out this high. Now, this entry is a very risky entry. I think I mentioned that it's an advanced entry model. It's an advanced entry model. And a safe entry model is for you because this was still on Tuesday. You would have taken this entry on Tuesday. But now, if you would have waited for Tuesday to close within the range, then on Wednesday now, that's when you are going to be looking for your entry. And which type of entry are you going to get? You're now going to be looking for a break of structure, which is this one, and then a fair value gap entry or a breaker block here, like this one. So if you would have waited for price to confirm the CRT, okay, to confirm the CRT by closing within the CRT candle, then we would have had this be, you can now comfortably get this breaker entry, which also aligns with this fair value gap as your entry. But for those who are very advanced, they could have had this entry, but then you'll notice that they will still be in the trade. They will be in some drawdowns. Sometimes the market from here could have just started dropping too. So it's also very important to practice so that you become used to this one as well. But if you're always looking for a safe entry, always wait for candle 2 to close. Okay, you can see that this was the Tuesday candle. So you have waited for this to enter this day, and then you trade it down. All right, so that's just one example. And we have remember the first thing that we put into consideration was the key level, which was starting even from the monthly time frame. We had another block from the monthly time frame, went down to the daily, had another order block again, and then we got our entry from the 1 hour time frame based on time frame alignment. Now let's try to see if we're going to have something. Now, also, this is a weekly CRT, Mr. George. This is another one here. Yes. Now, when we looked on the daily time frame, we noticed that we had price reading a high of a candle and then closing back below it. Now, you ask yourself, where did price read this high into? Now, we don't clearly see anything weekly, but on the daily time frame, we still notice that was price clearing that high into this zone. So also, this was a CRT on the weekly. Okay, this one is a weekly CRT. This range is a weekly CRT. This one. This is a weekly CRT here.
Yes.
Which also has a daily CRT as well. And one thing that has just come to my mind is when you have a CRT inside a CRT, it increases the probabilities of the CRT. All right, increases the probability of the CRT. Like we have a weekly CRT, and we also have a bearish weekly CRT, and we also have a daily bearish CRT. Now, if you want to trade the weekly CRT, which time frame do we get our model 1 and 2 from?
That is for 4 hour, weekly 4 hour.
Yes, good. So on the 4 hour time frame, what do we look for? We want to see as price rates the high, okay? As price rates the weekly high, what we want to see is price closing below the highest bullish candle, okay? Price closing below the highest bullish candle. And now, if I look here, I will notice that this candle right here, this is the highest bullish candle that I can see after the rate of the high, because this was where the high was. So price took out the high. This is the highest bullish candle that I can see, and I'll wait for price to close below it. Okay, so you notice this is the bearish candle that closed below it, and when it did, then price came back to retest it, and that's where you get your entry. So if you were trading it based on the weekly CRT, that would have been your entry. Okay.
Also, just a question. So that means that for every model 1, it has to be that specific one candle.
The highest.
That is either the highest or the lowest in case if it's bearish. So it has to be that one specific candle if it crosses below it.
Yes, it's the candle. No. Since it's your order block, right? So your order block has to be bullish candle. It has to be the last bullish candle.
Okay.
It has to be the last bullish candle.
Okay. And then another question. On the model 1, on the model 1, do you pick the wick or do you pick the body?
All right.
The open of
it depends.
Or the course of the body.
It depends on the candle. Okay. If the wick, like for example, this one has more wicks. So I try to include the wicks. But this one, look at this. If this was to be our order block, I would have prepared the body. Why? Because the body is more bigger. It's more bigger than the wick. Yes, it's more bigger than the wick, and price might likely be interested in the body of the candle than the wick. Let's see if we're going to see another example again. And let me just remove drawings here. Now, we notice this is the weekly time frame. We have an order block here. Price came back to the order block and then expanded to the upside. Now, this is not a CRT here because price actually, though it is a good CRT in the sense that price traded below this candle because of an opening gap. If not, if it could have opened exactly where this closed, then we would have had price trading down, not actually skipping down, because this was a volume gap. Price skipped to the downside before trading up. So if price would have opened at the same price here, then we would have seen that price would trade down and then trade back up, making this a valid CRT. But on the daily, on this weekly, let's accept that price has not price traded below it. Now let's check. Maybe on the daily we might have something like a CRT, but remember we're having a key level. That's the most important thing too. Now, so
I can hear you.
Okay, so we have same scenario here. We have same scenario here. Same thing. Same thing. Price skipped to the downside. Price skipped to the downside. If not, this would have been a very good CRT on the 1 hour time frame on the daily, because we had price closing above this one, so and already on a key level. So that would have made this a good CRT, but then the market opened with a gap. I think this was a new week and opened with a gap to the downside and then traded back up. Regardless about the gap, as I mentioned, we could still trade this area. We could still trade it with our model 1. Okay, we we'll still trade it at model 1. And in this case, the last bearish candle is this one. And we should have, now look at this one. This one has a more bigger body. So which one do I use? I don't use the wick here. I can use the body as my model.
Use the body. Okay.
Yeah. And then get your entry like that. And then you target the buy side, which is the CRT high. Now, this was another, I think this was, let's go to the daily. There was another CRT that happened here, right here. Okay, good. Now, take note of this one. We had something very similar here. We had a fair value gap, which is a key level. Okay, fair value gap, which is a key level. And then we're having this candle to be our CRT. Okay, so price, like I mentioned, there's CRTs that are going to just be 2 candles. Your candle range, and then the candle 2, which raises the high and goes to raise the low and goes to raise the high. But then this is a key level for us on the daily. So let's go to the 1 hour to find out how we could have traded this bearish candle as our CRT. Now on the 1 hour time frame, this is the area here. This is a zone. And if you notice here, this is where price took out the CRT candle low into that key level, which is on the daily. And what are you looking for? A close above the last bearish candle, which is this one. And that becomes your model 1 entry. And that's where you take your buy from, a retest of that candle. And then you target this high. All right, you target the candle range high. Now, for some people, they want to, they target the 50% of the range, or they take partials at the center of the range of the CRT candle, which means when price trades to the 50%, they close partials. They close partials. Some people do that. So it's the same thing, If you want to at least always maximize your profit, you can always allow price to move like that to the end. Let's see if we're going to see another CRT again. Let's go back to the daily. And let's see. All right, this is another one here. Okay. Price traded down to a fair value gap here, which is this one, quite a range, and then so we have a key level, and also price swept liquidity here. Now, if you notice, after sweeping the liquidity, we had price closing, taking this low and closing back with it. So this is definitely going to be our CRT candle. But how would we have gotten an entry from here? We can go now to the 1 hour time frame. And then on that 1 hour time frame, which is somewhere around this zone, you notice that this was the CRT low, and the price traded down, took out the low, and we are looking for a close above the last bearish candle. Which one is the close above? Now, if you look here, you notice that this is a bearish candle, and then this is another bearish candle. So this is the last one. This is the lowest bearish candle here. So if we
the lowest, okay.
We close above that, validate another block for us, which we can take our entry from there. And stops can be below that low, and then you target the CRT high. Now, for me, sometimes I will not target this high based on liquidity. I'll target this one. I'll target the overall.
Where there is the inducement, and then above the inducement there is some key level.
Now, this you can also use this model 1 just like confirmation. Okay, just like confirmation. For example, regardless of CRT, if this is another block for you, price comes into the other block, you can still wait for price to close above.
The last,
yes, and then you try to get your entry like that. So you can still use it just like an entry confirmation. Price trades into your other block, and then if the other block range is big, that's what I do. If the other range is big, then I can decide to wait for confirmation. But if it is not big, you can still just take your entry like that and then you target highs. But if it is a big zone, like
Yes.
this one was quite a big zone, you can wait for that confirmation. But if it's not a big zone, you can just fix a little and that will be it. Also, you can always watch out if price is bearish and we sweep a high like that, the last bullish candle is going to be your model one, and you can always get your entry as after a retest of that sweep. Why? Because you already know that institutions have induced or have gotten the liquidity they needed for prices to go lower, and how to mitigate their orders on that last bullish candle for prices to continue lower, and then you target lower prices. I think basically that should be it. Do you have more questions on that?
No, really, because I'm understanding it.
All right. So
Yeah, yeah, the model one. Yes, I'm quite understanding it. I think I need continue doing more practice on it. And because I was seeing where I was getting a bit confused, but at least now I've understood where, especially that's the entry of the model one. Because sometimes I used to like look at the entry and it has left me like you see the price refuses to come to my zone and it's a model one, but I've known where the mistake is.
sometimes,
Yeah,
sometimes you might not wait for a retest. Sometimes you
yes,
don't wait for a retest. Sometimes you can just enter, especially if price doesn't give you so much of a gap. Like for example, if I was waiting for this one, maybe let's just say, okay, let's just say this was a close above here, like or how do I put it? Let's just say this candle closed above this one. Now I'll just enter immediately on this candle, regardless if it's retesting or not. Sometimes you will not have that retest they are looking for. Okay, sometimes the retest will not come. I'm looking for an area where we will have something very nice like that to look out for, where you don't really have a retest, where you don't really have a retest. Like for example here, let's look at this case here. You'll notice that after price retested this bearish order block here,
mhm,
this is the last bearish candle, and then we closed above
yes,
it. You notice that
yeah,
this candle did not come back down to mitigate it. Now, in
yes,
cases like this, since the range is not big, I just enter. Now, one thing I always tell people is that trying to prove too smart is not even worth it, right? So long as you
yeah,
manage your risks. If you have been waiting that, okay, price will come down here, knowing that sometimes it only goes, it doesn't make sense because you're trying to prove a point to the market which doesn't exist. So why not manage your risks properly and then still get into the trade? Now, it depends where the candle closes. If it was here, I wouldn't have been taking that entry because there are possibilities that we are going to have this retest. Okay, but look at this point. It's not quite
yes,
a big stop loss for me to use. So I prefer to just get in and manage my risks accordingly. If I get in and at the end of the day, price comes back to retest, it doesn't matter. Okay, it doesn't matter. The thing is, you should not miss a trade you have been planning for just because you wanted to wait for some 2 pips for price to come back somewhere and you get it. All right, that's